how is everyone doing? This is Laura, and welcome back to another presentation into the trucking business. As every Thursday, we are back with the freight market update. If you're an owner-operator, you know the deal. You live and die by the spot market. And for what feels like forever, the big question has been a tough one. Are rates going up or are they going down? Well, today, we're going to cut through all the noise, dive straight into the data, and give you a clear answer on what's really going on out there. So let's just get right to it. This is the question, isn't it? It decides your bottom line, it decides your home time, it decides pretty much everything. Are the numbers finally moving in the right direction? We're going to answer that right now, and then we'll show you exactly why it's happening. Alright, so no beating around the bush. Let's get right to the short answer to that very big question. Yes, that's the answer. After a long, tough stretch, the data is crystal clear. Spot market rates for all three major trailer types are on the rise. And that's some welcome news for every carrier out there. So let's break down exactly what that looks like. You know, to really understand the market, you gotta look at the numbers segment by segment. So let's pull out the report card for dry vans, reefers, and flatbeds and see how they're doing compared to this time last year. Let's kick things off with the workhorse of the trucking industry, the dry van. This is the segment that really gives us the pulse of general consumer freight. And the news is definitely good. The national average spot weight for a dry van is sitting pretty at $2.03 per mile. We are back over that $2 mark, which you know is a huge psychological and financial milestone. But how's that stack up against last year? So we look year over year, we're up about 7 cents a mile from 2024. Now, I know, 7 cents might not sound like a massive jump, but over thousands of miles, week after week, that adds up to real money in your pocket. More importantly, it shows the market is firming up and carriers are finally getting some of that pricing power back. Okay, next up, the reefer market. This is where things like seasonal demand, especially with produce, can really move the needle on rates. And yep, reefer rates are also looking strong, coming in at a national average of $2.01 per mile. Right now, we're seeing the push from fall produce shipments, especially coming out of the southeast in places like Florida, that are really driving this demand. The year-over-year improvement is solid here too. We're looking at a 4-cent per mile gain compared to last September. It's another steady, positive trend that points to tighter capacity and higher demand for all that temp-controlled freight. Okay, let's finish up our report card with the flatbed segment. And listen, right now, this is where the action is. This is, by far, the busiest market out there. The national average is leading the whole pack at $2.06 a mile, but that number is actually hiding some seriously hot regional markets. For instance, if you're running flatbed out of West Texas right now, you're probably seeing rates closer to $2.60 a mile, all thanks to that steady energy sector activity. The growth here is just huge. Flatbed rates are up around 5% year over year, which makes it the tightest market of them all. And to put that into perspective, for every single flatbed available on the market, we're seeing an all-time high number of loads posted. It's wild. So, we've seen that rates are up. Great news. But now for the most important part. Why? It all boils down to the simple, powerful engine of the spot market. Good old-fashioned supply and demand. And to really get this, you gotta know one key metric, the load-to-truck ratio, or LTR. It's super simple. It's just the number of loads posted on a load board for every one truck that's available. When that number goes up, it means there's way more freight than trucks, and that's when rates really start to climb. Okay, this slide right here tells the entire story. On one side, you've got demand, and it is absolutely surging. Dry van load posts are up a staggering 40% over last year. Reefers up 35%, flatbeds up 22%. But then you look at the other side, supply. The trucks, they've just vanished. The number of trucks posted is down by about a third compared to last year. You know, the math is simple, and it is powerful. When you have way more loads and way fewer trucks, the power shifts. It becomes a carrier's market, period. You have more options, you have more leverage, and you have the ability to negotiate for better rates. This imbalance is the engine that's driving everything we've been talking about. But wait, there's another factor at play here. A new regulatory wildcard is making this already tight market even tighter, especially in certain parts of the country. So on June 25th of this year, the FMCSA brought back a rule that lets inspectors place drivers out of service if they can't demonstrate basic English proficiency. Now, this rule isn't brand new, but the enforcement is, and it's starting to have a real effect on capacity out on the roads. And this isn't just some warning on a piece of paper. As of early September, about 3,100 drivers have already been taken off the road for failing these assessments. Now, that might not sound like a massive number, but in a market this tight, taking 3,100 trucks off the board has a real noticeable impact. And here's the really crucial part for your own business planning. The enforcement is not the same everywhere, not even close. States like Texas and Florida, they've gone zero tolerance, actively inspecting and removing drivers. But then you have states like California, Washington, and New Mexico with pretty much no enforcement at all. This creates this patchwork map where your risk and the available capacity can change drastically just by crossing a state line. Okay, we have covered a lot of ground and a whole lot of numbers, so let's boil it all down into what this actually means for you and your business strategy as you move forward. So if you only remember a few things, make it these. First, the power has shifted. It is a carrier's market right now, all because capacity is so tight. Second, make that load-to-truck ratio your new best friend. It's the clearest sign of where the best money is. Third, use that LTR to look at the map. High LTR markets like Florida and Texas are screaming with demand right now. And finally, because of that new ELP rule, your location and your compliance strategy are more critical to your business than ever before. So, we'll leave you with this question to think about. The market has clearly shifted in your favor. Rates are up, capacity is squeezed. Armed with all this data, where are you going to position your truck to take maximum advantage of these opportunities? It's a good time to be a carrier who knows the market. Thanks for tuning in.